Hello everyone, welcome to Nirmal Bang Podcast. I am Ritu Podar and today we are going to talk about most volatile, bold category which is a small cap, and today we have Mr. Chandra Prakash Padiyar from Tata Asset Management Company. He is in this financial market since 25 years and he caters to the different roles and different organization. So welcome to Nirmal Bang Podcast, sir. And just wanted to understand here, let's start with the macro. The kind of a macro is going in the current market scenario. What's your reading and how it is going to impact on a small cap as a market capitalization?
So thank you, Ritu, for having me, and thank you, Nirmal Bang, as an organization for hosting us. So I would say that on macro, there are two parts to it. One is the global macro, and clearly headwinds are increasing. There are trade issues, or some call it trade war, going on. Started with from the US, and tariffs have been increased, and there is some extent or a large level of protectionism going on. Fortunately, as a country, let's say India specifically, or from a listed space perspective, goods exports from India to the US is not a material number. On an average, it will be exports as a percentage of revenue itself would be closer to 10 or less than 10% in many cases. But what is more important is exports to the US has always been as a smaller number. Indian economy, or many Indian companies we observe, have been catering more to the European region or to the Asian region, MENA region, some extent US. So direct impact, as we see it, is not a material number. But if global growth were to slow down, which just last month we saw global agencies like IMF reducing global growth estimates. So in that sense, indirect impact is certainly going to be there. More on services export, because we as an economy in India, we export more services like IT software and other things. So to that extent, there will be some impact. But from a small cap perspective, the second part of your question, what we are seeing, or let's say before this, I would want to categorize how we see small caps. First of all, from a definition perspective, small caps starts from 251st rank and below from a market cap perspective. Till December, this number was 32,700 odd crore. So let's say on average around 33,000 crore. So it starts from 33,000 crore market cap and below. So these are decent sized companies. Since our fund size has grown, generally speaking, we look between 4,000 and 33,000 crore on an average. In this, there are 550, 600 companies in this universe of 4,000 to 33,000 crore. Out of the 600 companies that we look at, 65% or a very large part of this universe is manufacturing oriented companies. Manufacturing, logistics, supply chain, or more like 70% actually. So which means that we should be focusing more on manufacturing when we think about small cap investing in India or Indian listed exchange. And out of this 70% of small caps that we look at, a very large part over the last few years has been a beneficiary of Make in India for India. What I mean by that is that there are quite a few companies or businesses that we look at. They have benefited from lesser imports and more indigenization within India. So these companies would have done something right in their business to create new products, invest in R&D, launch or competing products relative to Europe, US, China, more China actually. I think this trend is irreversible. We are seeing good and early signs, or very healthy signs, for Indian companies gaining market share relative to a China or relative to a Europe. Cost structures in Indian companies are either equal to China, or in some cases actually we have seen them to be very competitive relative to China. Whereas there are cases where cost structures to China is higher, but quality is equally good, or they have come up with products or service quality. Since companies are present here, you can service their customers better. So net, I would say that when I consider small cap as a universe, we do not yet see a major challenge in this calendar year or in this financial year on earnings at all. In fact, when I look at, or let's say the portfolios that we run in Tata Small Cap Fund, we are still very optimistic of healthy or very strong earning growth over the next few years. So in this challenging environment, when you think about small caps, we are relatively optimistic on earning delivery.
Okay. So here I just want you to understand, as you said, you are optimistic about your portfolio which you have built for Tata Small Cap. As you said, there are the, large universe, you get it in a small cap, and 33,000 below companies falls in small cap. How do you define the compounder kind of a story? How do you select? Because there is a chances that value trap also it's possible, because you see the price or the valuation comes. How do you ignore that, or how do you pick the right stock?
Yeah, so it's you are very right. These are challenges that every investor faces. More importantly, you have to identify businesses. From our perspective, we try and identify businesses where growth delivery or growth in cash flows on an annual basis needs to be very strong. I think we are not deep value investors. So from an investment thought process perspective in Tata Asset Management, we are more growth at reasonable price investors, which means that we look for companies where sustainable growth in cash flows can be there in our investment horizon, along with the fact that you need valuations to be on your side, which basically means that we tend to buy early, we tend to buy for the long term, we do not churn our portfolio too much, and we buy very selective companies. We don't like to choose, or we don't like to over-diversify a portfolio, because at any given point in time in any economic environment, barring the last 3-4 years, because our base effect was very low in 2019-20. So between 20 and 24-25, most small, large, mid companies, or every company actually, has grown earnings at 20% plus CAGR. But that was because our base was very low in 2020. Today our base is large. We are listed universe. I think the profit to GDP has crossed 5.3%. In 2008, the peak was 6.8%. 2020, by the way, was 1.7. So from 1.7, we have come to 5.3. We are no more a small base. So from this base, either on an aggregate basis, you have to now start growing more closer to nominal GDP. If your nominal GDP, as per the government estimates, is likely to grow at 11% over the next few years, then earnings will not be very different than 11 to 15% in that band. So, which means that what used to be 20-25% growth earlier, on an aggregate basis, you will be double digit, but not very high double digit. In that environment, it is your responsibility as a fund manager, because there will always be some companies will do a good job and some companies will lose in that environment. But it is our responsibility to identify companies which can continue to grow at a fast pace. So today what we are doing, and that's the challenging part that you mentioned, is that you have to identify companies. You have to be very selective and identify companies which can do a good job. So what we are doing right now, for example, is that over the last 12 months, in the Tata Small Cap Fund, we would have churned, or we would have changed the portfolio. 60-65% of the portfolio we have changed.
Okay.
So we have, what you see today is a new portfolio in that sense. And our focus has been, so we were anticipating global challenges coming.
Okay.
And we were also saying that if the base of profits is growing to such a large extent, then from here on, if I have to do well, I have to find the next round of growth companies. How do you do that? So one of the ways that we've been able to, or we think we have done, is to focus on R&D focused companies.
Okay.
So to a very large extent, we have been focusing on businesses or management teams who have invested ahead of times, who have spent last 5-6 years creating some new products or new processes in their businesses, and which they have either launched in the last 1 to 2 years, because it takes time for scale up to happen. So either it's already been launched, or in a few companies we think next year or the next 12-18 months would be a period where launches will happen. So we're not dreaming about a launch, we are seeing visibility of that launch happening in the near term, which makes us optimistic that even at this base, because they've done something new in their business, they will be able to scale their profitability at a very fast pace. Let me give you an example of this without taking names.
Yes.
We have, for example, a pharma company today in our portfolio, which has just completed studies for their molecule, their R&D molecule, where for US FDA phase 3. And the studies, research data had come out. They have publicly shared it with everybody, and it shows that their molecule is 80% plus efficacy and the best ever in that category in the past globally has been 64 or some percent in mid 60s. So in that sense, they have a fairly good product profile, and the test results are showing good numbers. Now, if they succeed, so they'll now be filing for US FDA phase 3 approval soon, and hopefully in the next 6-12 months, they will get an approval. But if they get an approval, the earning growth profile, the profitability profile can be very different than what you see today. This will be the first time ever that an Indian company will launch a global molecule in pharmaceuticals. Now that's small cap. Again, I can give you one more example. There's another agrochemical company which has been doing research in R&D for the last 10 years. And they have also filed for approval for their own insecticide. And our understanding is that, or the company is seeking approval to start with in the Indian market, to launch it in the next 12 to 18 months. In agrochemical, it is most easier to get approvals actually. It doesn't take so long in like pharmaceutical. So the probability of them getting approval is very high. But then they will launch it in US and Brazil and other global markets as well. Again, this will be the first agrochemical molecules from an Indian company for the world. So this we have not seen in India for since the time I have started my career. R&D was not a topic that we used to discuss on. But today we are...
Can we say here like data, the sourcing of the stock or sourcing of the businesses is the key recipe or key ingredient of your portfolio?
No, so I would say that, see, this is public data.
Okay.
So both these names have told the whole world that they are working on it and they think they will succeed. And now but it is up to you as an investor to whether to invest or not, or whether you invest today or you invest just in time when the approval comes. So there are shifts, even if the probability is high, but there is a probability of success or no success on that molecule. They may fail as well. Even though the probability is low, so we as a fund manager, that's our job to. So in other words, I would say that it's also a bet that you take on the time horizon that you invest in. That one, at this point in time, if I invest today, our view is that if you invest today, I think the market is not yet discounting the molecules that are being launched. So your risk is lower, and if the approval comes, then your reward can be very high. So we are willing to have patience. Like I said, the approval is not happening today. Approval is going to happen in the next 12-18 months. So there is a time horizon for which you have to wait. I would say that though these kinds of information is available in the market, the management has been talking about it, but we do not see many investors taking that long-term bet on innovation pipeline for many companies. And we think that these are two examples that I gave, but I have many more examples to share actually in the portfolio. So what you do as a portfolio manager is you balance your portfolio. So some R&D portfolio companies, you bet for 1-2 years for that molecule to succeed. Some R&D businesses you bet for the near term, and some, as I said, companies have already launched and they are now benefiting from scale up of the molecule. So you have a good mix of products. So you balance your portfolio in a manner that short term, medium term, long term, everything is taken care of in terms of performance. So I was just trying to give you an example of what we are doing.
Yes.
So your question was that we are hopefully not stuck in a value trap. And where you are thinking of something which doesn't happen and then the stock doesn't.
Correct.
So you have to balance in a manner that some businesses, even if you're taking some risk, let's assume that it doesn't work. What is your downside? And do you have other businesses will take care of returns in the future? And so I was trying to tell you that we have a good mix of businesses where some are delivering earnings as we speak and some will come 6 months later, some may come 12 months later. So that makes us a bit more optimistic.
So it's like a more on the conviction call you are taking on these kind of companies in an early stage rather than when they get a approval and the entire world is behind those kind of stocks you are taking. I'm sure, in the risk return parameters, if you look at, you find that it's a much more balanced kind of a stock or the companies or businesses to take bet on that. Right?
Absolutely. So that's a style. As I said, one, we are looking for growth in cash flows consistently, but 2 is reasonable valuation. So as in terms of our style itself, I said that we are early investors. We like to buy early. When nobody is looking at a business, we like to buy them, hold them with patience, and when the earnings actually come, when everybody wants to buy, we are selling and then going to the next round of company. So that's our style. So in that sense, I think we were in 2024 when the world was bullish on small cap, we were selling most part of our portfolio and we were buying businesses which we thought market is ignoring, and which is where I think fundamentally we are relatively more optimistic because we've bought businesses which nobody wanted to buy, and when the earnings comes, which we are very hopeful that earnings will come in the next 6, 12, 18 months consistently, there will be good performance by these companies. So as and when companies deliver earnings, then we should get our re-rating.
Okay. So one you said that in the small cap universe, mostly you will find the companies which are on a manufacturing or manufacturing related. Second, you said that early stage kind of a companies you prefer.
Not exactly early stage. These are good, decent sized companies already, but they have done something in their portfolio which is early stage.
Understood. That way, slowly, they are in the businesses, new businesses or new products in terms of you are probably taking. So as a whole, if I say, without taking name and without breaching compliance, if you can help me to understand how Tata small cap portfolio right now looks, if as an investor, I would like to say.
So the way I would see it, like a general point that I was making earlier,
Yes.
Tata small cap fund from a positioning perspective would be more like 55-60% manufacturing portfolio. But very different kind of manufacturing, in the sense that what I want to highlight is that generally when you think about manufacturing and media and analyst community, when they talk about manufacturing, generally the sentiment is that manufacturing means large export potential. But instead what we've been focusing on are businesses who are in simple terms, I will use Prime Minister Modi's statement is make in India for India. So we have focused more on companies which are more looking to gain market share on the Indian market itself, or focusing more on the domestic market itself in a very large manner. Some multinational companies, some Indian companies, good quality, no debt on balance sheets. But these are businesses where we think there is a competitive edge in the product profile itself, which they have created or which they are creating, which can create large growth parameters for them. So that's one part, which is that we are not focusing on such a large export. Some companies will obviously export as well, but a large part of these manufacturing companies are dependent on their home market. There are 1 or 2 companies which are global leaders in their business, but they have manufacturing plants across the world, and they will supply to their respective countries. Those plants are not for global supplies. They are more in their home country. So so in other words, in a world which is slowing down, we are not betting on global growth. in that sense. So we will hopefully not get negatively impacted. That's a large part of our portfolio.
Okay.
Beyond this, what we see in India is that there is a potential for select service-oriented companies to do very well. So like logistics supply chain or like staffing solutions in India in the small cap space. And lastly, we have a mix of companies in the consumer space. So surprisingly, we do find some good quality consumer-facing companies, which are also into manufacturing, but which have branded products to sell to consumers in the household space.
Okay.
We've been able to identify some names there as well. So that's the flavor of portfolio. But as a concluding statement, we are very stock specific. We do not build our portfolios on thematics or sector specific. So the reason why I was giving a broader framework to you, what kind of companies, is that we've not bought sectors or themes. We've bought merits. We've bought businesses for their own merit, and which is why individual companies' earning growth will matter. Which is why our portfolios are not very diversified. We would have around 55-60 stocks in the portfolio today. And out of which 40 would be the key portfolio stocks, and there's a long tail then. But those 40 would be more like 80% plus of the portfolio.
Okay.
So this 40 is what is relevant for me in that sense, and we focus a lot on these 40 names.
So currently the earning season is going on, and you are talking about these 40. What's your reading about the earning growth of these 40 companies? If we talk.
So I would not be able to give an exact outlook number in that sense from what we expect of these portfolio companies. But on a general basis, I can say which is what I mentioned to you, is that we are looking at a very high double-digit growth from these portfolios.
Okay.
And the reason why we chose these companies actually when we were churning our portfolio in 2024 is that one, we thought people were ignoring, or market was ignoring the fundamentals of those companies. But two, there were some triggers which will lead to high growth. We've seen 2 quarters of earnings from this new set of companies that we delivered, which we have acquired. And so far the trend looks very positive.
Okay. So now from the client's perspective, what's your opinion? Is this a good time to enter in a small cap space, or whether they should hold or invest, or what's your take on that?
Or let's take one main viewpoint first, which is that if, at least we believe this, and hence I'm taking this assumption first, is that if you believe, then Make in India for India can succeed. And potentially in future, Make in India for the world can also succeed. Then B2B manufacturing, which is what small cap is all about. As I said, 65-70% is this only. So if you believe that manufacturing in India can succeed, then small cap is certainly a big place to be in. And at least we in our universe, when we look at companies, not all will succeed, but a very decent part of this universe is doing enough or making enough efforts. Like for example, in auto ancillary, or in certain capital goods industrial space, we do already have scale in global terms. And in some spaces like forging and casting, we are actually the number 1 supplier in the world. So there are places or specific areas in our market in manufacturing where in pharmaceutical manufacturing, we are also generic manufacturing. We are already number 1 actually in terms of manufacturing. So there are cases where you do find scale in a very large manner. Plus, I think geopolitics of the world today, the way things are, we are seeing advantage India from a manufacturing perspective increasingly. Like every day nowadays, you see, though you are seeing more on the electronic side, you see very often news flows on electronics, especially Apple iPhones are quoted very often by media that India is gaining a lot of market share in the world for manufacturing mobile phones from India for the world. But what is not very quoted very often is that we are doing this in many other places, small segments. Textiles, we are very large. We are increasingly becoming more relevant with UK-India FTA happening. I think our growth will increasingly happen even more. So things are, so in that sense, we are optimistic. But to come to your question, should one be investing in small cap in markets at today's valuation? I would say depends on your return expectation, which is that between 2020 and 2024-25, investors have made 25% plus CAGR at a stretch. So they have made a lot of money actually from the small cap segment. I do not think that level of returns is incrementally possible given the current environment. At the valuation base where you are, I think 25% plus return, assuming that kind of returns forever, cannot happen. Ultimately, earning growth is what drives your returns. So I think, as I was saying, if your economy is growing at 11-12% nominal term, then you can't expect long-term returns to be that much. But can you expect a reasonable return given the earning trajectory that we are seeing in our portfolio company? I think yes. So one, your return expectation needs to be normal. So for example, when I started my career in 2000, today we are in 2025. In the last 24 plus years, Nifty earnings have grown by more like 13% CAGR. And Nifty returns have also been around that number for the last 24-25 years, slightly more than earnings. So if your earnings is likely to be healthy double digit, then your returns will also be more in line with healthy double digits. So that if that is your expectation, I think they will not be disappointed.
So resetting the client's expectation is required at this moment, because client already made a very good, as you mentioned, like double digit and higher double digit kind of a return.
Especially at a time when global growth outlook is slowing down. And you have this trade environment which is disrupted.
Okay.
It makes sense to bring down your expectations.
So in terms of client behavioral biasness, if we see, what do you think? I mean, what kind of a changes they can do in their behavior to if they are holding a small cap funds or a small cap portfolio? Because as of now, clients do not have a patience, which we see. They want to make quick money. So what's your advice to those set of clients, basically?
So the biggest advice that all of us give is compounding works wonders.
Yeah. Okay.
I think 12% over 6-year period means that you double your money. So the longer you wait, 12% itself is a very good number actually.
Yeah.
So if you think about it, in a very short period of 15 years, you can multiply your wealth significantly, even if you make 10 to 12% returns. So the longer you wait, the better it is. But especially from a small cap perspective, what I've observed is that because of the rally that we have seen in the last 4-5 years, and maybe my observation may be different, your observation may be different. So, but what I observe is that there are still some investors who have allocated a very large part of their wealth only in small cap or small cap funds.
Right.
I think probably time has come for them to readjust that portfolio.
Okay.
A large allocation to small cap at this valuation and this point in time may not be the right allocation to have. But it also doesn't mean that you go to zero. So there is a right number today. That right number depends on your ability to take risk, savings profile, your age profile. So obviously you need to take advice from experts. Nirmal Bang as an organization is an expert on this. So your investors should stick to or take advice from your people and reallocate. But I do listen. So there are comments in the market which we get very often nowadays is that should we go to zero in small cap, because there are many commentators, stroke fund managers who have given a negative view on small caps. So to that, I would say that earnings trajectory for at least what we see where we are invested in our funds, we are not yet seeing slowdown in earnings. We are seeing a very healthy earnings outlook for our portfolio companies over the next foreseeable future. So which means that we are still optimistic actually. So we think we can deliver reasonable returns over a long period of time. Short term, nobody knows. So the risk reward continues to be in favor. So 0 is not the right answer. It's somewhere between.
Okay. So first is a reset, investors' expectation in terms of returns from the small cap, which we have seen earlier is not, probably you can get in the upcoming years. And secondly, I think investors should be very selective when they are picking up funds or when they are giving an allocation to certain funds. So that also probably help them to make their portfolio. So thank you for coming and on Nirmal Bang podcast and giving us insights on a small cap as a space where people generally try to take a bold kind of a decisions, but sometimes they actually get bold. Thank you so much.
Thank you so much, Sati, for having us.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.